Welcome to the December 14th Holistiplan webinar, The Gift of Giving, Modeling Charitable Giving inside of Holistiplan. My name is Ben Birkin. I am the Vice President for Customer Success and Engagement here at Holistiplan. I'm joined by my colleagues, Madeline and Emily, who are going to be overseeing the chat and the Q&A box. So let's use the chat for chat. If you have a specific question, though, please use the Q&A box. We'll either get things answered right there in the Q&A box, or Emily or Madeline will leave things open and we'll cover them in real time on our screen here. But the chat's a fun place to kind of do a little bit of a back and forth, but because things go so quickly in there, it is easy to lose a question. So if you have a specific question, please use the Q&A box and we'll get things going that way. We're only scheduled to go, I think the registration said 45 minutes. It might not even go that long, right? We're focusing on a specific topic here in terms of what to model or how to model things inside of Holistiplan. We've started doing some more of these specific webinars. So we've always had, for the last year or so, we've had office hours, which we will continue to do going into 2023. That's going to be open-ended. People can come with whatever questions they want. We don't go in with any agenda, and we're kind of working without a net. So it's kind of fun sometimes to see how that works. We do one where we talk specifically about how to read and use the tax report. So Holistiplan's deliverable, or first deliverable. We have another one where we focus specifically on range calc and scenario analysis, which is kind of like today's little subset of that. And we try to intersperse a few things going on in there. But given where we are in terms of tax planning season, and given the questions that we've been getting coming in from the support side, we thought we'd do just a little quick hitter about how to correctly model charitable giving inside of Holistiplan, because there's really two primary things that we're going to focus on. I'm actually going to share my screen so that we can look at Holistiplan. This is one of our this is one of our sample clients here. This is a retired couple. So this is Robert, retiree, and Roxanne, retiree. I'm going to be using them because with these folks, we can appropriately show the two primary charitable contribution things, one of them being donor advised funds and the second being qualified charitable distributions. And we'll talk about what each of those things mean. But let's jump into the scenario analysis screen for Robert and Roxanne, because that's where we do any of these modeling, right? This is where we do the modeling for anything related to taxes, both this year and in future years. We'll just start by saying, when you jump into scenario analysis, if you haven't been here for a while, remember that the first column, if you're getting here based off of an uploaded return, will always have that previous year's return information kind of baked in here into this first column. It's hard coded in, so there's no editing that you can do or need to do. So this is their 2021. Just for a little bit of background for these folks, at least in 2021, they weren't yet, Robert wasn't yet needing to take required minimum distributions. They have some Social Security income and some investment income, but that's pretty much it. They've got a little bit of rental income, and this $999 was meant to be, at least in that year, like a very small Roth conversion. So here they are in 2022, and I already preloaded this a little bit with, I'm assuming they have the same income coming in from investment income, and I've upped their Social Security amounts by a little bit, but that's really it. Where we would first start thinking about charitable giving, I think most folks naturally go to deductible gifts, right? So gifts that are going to be found on Schedule A, which makes sense, right? That's kind of where we're conditioned to think about making charitable gifts that might be deductible for tax purposes. Obviously, people can make charitable gifts that aren't deductible, right? And there's nothing you're going to need to do in Holistiplan for that, but clearly anybody can write a check or send money to a charity whenever you want to and not necessarily claim a tax deduction for it. But for those folks where their itemized deductions exceed what they're eligible to take a claim on the standard deduction side, there might be a tax benefit for making such a deduction or making such a contribution. We report any sort of deductible charitable gift on Schedule A with all of our other itemized deductions. Those other itemized deductions being things like deductible medical expenses, state and local income taxes, mortgage interest, if there is any, and then we've got our charitable gifts right here. So to make this a little bit more appealing or a little bit more compelling, I'm going to give these folks some gross medical expenses Notice that I'm not going to be able to take the full deduction for the medical expenses because medical expenses are only deductible to the extent that they exceed 7.5% of adjusted gross income. Going to assume that they had to pay $6,000 in state and local sales tax or income tax. The makeup doesn't matter. We know that this dollar amount is going to be capped at $10,000, right? That's one of the Tax Cuts and Jobs Act limitations, is that no matter what you had for state and local taxes, income taxes, real estate taxes, or what have you, it's going to be capped at $10,000. And that's it. That's all I'm going to give them for right now. I'm also going to say, for the purposes of right now, well, let's not do it this way. Let's actually just keep them without having to take an IRA distribution for right now. Let's say that these folks want to do some sort of gift to charity, right? The way that we would model that inside of Holistiplan is we'd come to our charity row. We're going to click on this little pencil icon that says charity worksheet. And when I click on that, it's going to open up a whole bunch of stuff here. This $600, this was carried over from the 2021 return. Recall that in 2021, even people who took the standard deduction could take a small charitable deduction, right? If you sent cash directly to a qualified charity, you could deduct up to $600 on your federal return if you were married, filing joint individual. I'm going to delete that out because we're starting brand spanking new here in 2022. Now, when you come to this worksheet, if you're not familiar with the way the IRS wants you to think about charitable contributions, it might seem a little bit overwhelming. It's not nearly as complicated as it looks, right? Because most of these fields, most folks will never use, right? But we need to have them on here because the IRS says there is a limit to how much you are allowed to take as a deduction for charitable giving, depending on what you're donating and who you're donating it to. So what you're donating is going to be broken out into 3 different categories. Cash, which is the easiest, right? You just write a check to somebody. Non-cash, non-capital gains, which when you first see that, you're like, what does that even mean? Well, that's like donating your car to public radio, right? It's not cash. It's definitely not capital gains unless you're donating an antique vehicle that is appreciated in value. So non-cash, non-capital gains would be like stuff. And then capital gains donations, which would be donating appreciated stock or appreciated mutual fund shares to a charity. So those are the 3 things: the what? Cash, non-capital gains, and then capital gains. And then to the different types of charity, there are only 2. There's what are called 50% limit organizations and non-50% limit organizations. I'm going to wager that 9.5 times out of 10, most of your clients are donating to what are called 50% limit organizations. That's because every public charity is considered a 50% limit organization, including donor advised funds, right? A donor advised fund is a public charity. The non 50% limit organizations are usually like private foundations or fraternal lodges. In just a minute, I'm going to show you a resource that the IRS has where you can actually look up what a charity is in terms of whether it's a 50% limit or non-50% limit organization. So in case you're ever not sure, there is a resource you can use. But just know that every public charity is what's called a 50% limit organization. That name comes from back in the olden days. That was the limit that you could take as a percentage of your adjusted gross income. Right. So that if you were donating to a particular charity, you could take up to 50% of your adjusted gross income as a donation. Right. But that name has stuck, even though some of these percentages have moved around. But the way these 2 things interplay with each other is that donations of cash to a 50% limit organization have a different limit in terms of the deductibility amount compared to the capital gains donation. Right. So Adam, you asked this question. I don't believe the $600 charitable donation, I don't believe that got extended to 2022. It was there for 2020 and 2021. I don't believe that it has been extended to 2022. So good question. So if we were to, let's just kind of come back. I'm just going to remind ourselves what our adjusted gross income is for this particular client. So it's about $58,000. Right. So if I'm in my charitable contributions, where did I go? I lost myself. There we go. Charity. So if I were to give these folks a cash donation, let's say they wanted to write $100,000 check, you could put $100,000 into this row, but Holistiplan will cap the actual calculated donation as a percentage of their adjusted gross income. See, we already did it right here, $34,716. And if you can see down on my screen, you'll see that's the deduction that we're using. And we'll say, here's how much of your charitable gift you could carry forward into a future year, right? So it's not lost forever. You can carry it forward for up to 5 years. Holistiplan isn't going to automatically apply carry forwards to future scenarios. The reason for that is because within Holistiplan, scenarios don't need to be linearly linked, right? So the next column doesn't have to be 2023. It could just be 2022. But we'll tell you, at least at a bare minimum, here's how much you would use as a carry forward to that next year, if and when you ever got there. If we put that same $100,000 gift, instead of being cash, and it was a donation of appreciated stock, notice that the calculated deduction amount is lower, right? $17,358, right? But this is all you need to do if you are modeling these gifts. You just have to put the right number in the right field. So is it cash, non-cash, non-capital gains, or capital gains? And then is it a 50% or a non-50% limit organization? Just so folks can actually see this. Let's see if I can get to, I want to pull up. There's a tax exempt organization search inside of the IRS website where you can come and actually search for a charitable organization. So I'm going to search one of the nearby charitable organizations. It's the Chatham Education Foundation is one that's near me. This will pull up ideally any tax exempt organization that is registered with the IRS, which should be all of them. If I click on the Chatham Education Foundation here, I'm going to get this little breakdown of who they are. But then on each of these, there will be a deductibility code. So if I click on this deductibility code, it says PC. If I click on this little question mark, I'm going to see this table that says this is a public charity, deductibility limitation 50%. Right, so that is the 50% limit organization. So if I were donating to that charity, or my client was donating to that charity, I would use any of the appropriate 50% limit fields, right? Again, if you were going to do a donor advised fund is considered a public charity. So depending on the nature of what you're giving, you would use either the top box, the third box, or the fifth box. If you're donating stock, first box, second box, or the fourth box. If you were donating stock to a donor advised fund, you would use the fourth box. If you're donating cash, you would use the first box, right? And I'll come back to the DAF explainer in just a minute, but I did want to walk through the second way of doing a charitable contribution, or at least the second strategy that many folks talk about when they're thinking about charitable contributions, which is a qualified charitable distribution. So Adam, you asked a question, what is the second box? I think the second box, I'll bring it back up really quickly. The second box is non-cash, non-capital gains to a 50% limit organization. So again, that would be like donating your car to National Public Radio, right? It's still worth something, but it's not a capital gain anymore. It's certainly worth less than you paid for it. It's a real asset, right? Okay, so the other option that many folks, or the other strategy that most folks think about when they're talking about charitable giving is the concept of a qualified charitable distribution. A qualified charitable distribution is a distribution that comes out of an IRA, goes directly to a charity, does not count as income, so it's not going to be reported as income anywhere on the tax return, also does not count as an itemized deduction, so it doesn't show up on Schedule A, but it does count towards somebody's required minimum distribution, right? So already our wheels can be turning and thinking, okay, I've got these folks with these RMDs, they don't need the money, or maybe they do need the money, but they still want to have charitable intent. But I want to keep adjusted gross income down because I don't want that to impact Medicare premiums. You know, is there anything I can do? Well, here's your answer, right? A qualified charitable distribution. So a QCD, you can do up to $100,000 distribution from an IRA as a QCD, but you can't do them until you turn 70 and a half. It's a really weird situation. It's not like the year you turn 70 and a half. You actually have to be, according to the rules of the IRS, the day you turn and after 70 and a half. So if you turn 70 and a half in July and you do a QCD in February, technically you're not allowed to do that, right? So technically you're supposed to wait until you turn 70 and a half and then you can do your QCD. But within Holistiplan, how you might go about modeling a qualified charitable distribution is going to be on the IRA distributions row. You're going to click on the IRA distributions worksheet, and that will bring up this worksheet. We get a lot of questions about this in terms of why isn't this doing what I think it's going to be doing? So I'm hopefully going to put a lot of that to rest right now. The top portion of this worksheet is for taxable distributions. Taxable distributions, right? Whether it's an inherited IRA or from a person's individual IRA, it doesn't matter. These are supposed to be taxable distributions. So if you had a $100,000 required minimum distribution and you weren't going to do anything with it, you would put $100,000 right here in the top line, right? And we try to tell folks, these are the IRA distributions used in the income tax calculations, $100,000, right? If you wanted to do a qualified charitable distribution, so Stephen asked the question, the QCD age is less than the RMD age of 72. Yes, it is, right? Weird, right? Because when they pushed back the RMD age to 72, they didn't change when you could take a QCD. So now you have this weird year and a half where you could take a QCD without needing to take a required minimum distribution. Now, your mileage may vary in terms of whether you think that's a good idea or not to do a QCD when you don't need to take anything out of an IRA, but you technically can do a QCD before you need to take an RMD, right? So with this particular situation, if I wanted to model, instead of taking $100,000, my RMD is $100,000, I wanted to do some portion of that as a qualified charitable distribution. Let's say I wanted to have somebody do a $20,000 qualified charitable distribution. Well, I would enter $20,000 down here, but notice that it's not going to change anything that's up here. It's not changing anything up here because we still said we have a $100,000 taxable IRA distribution. So to make this still total $100,000, I just need to back this down. And now between the two, right, I've got an $80,000 IRA distribution. I've got a $20,000 QCD. Only $80,000 is going towards the tax calculation, but my total distribution for taxpayer one is $100,000, right? We just added this text like this week, right? In the original iteration of Holistiplan, we didn't have anything that called out qualified charitable distributions. We just had taxable IRA distributions. We added this QCD field, A, because users wanted us to have something that highlighted just QCDs, and B, because it helps us put forward the QCD explainer, which I'm going to go to in just a second. But we get these questions quite often about, well, I'm entering something in the QCD field, but it's not changing the tax picture at all. It's not changing the tax picture because we haven't changed the taxable distribution amount up here, right? That needs to be a manual process. So I could make this whatever I wanted to, $20,000, $50,000, $100,000. It's not going to change the tax picture. Why? Because I'm changing a field that has no impact on the taxes at all. By doing a $50,000 QCD, I've now said my taxpayer one is taking $130,000 out of the IRA, right? If I wanted to make sure I was still maintaining a $100,000 total IRA distribution, I would need to back this down from $80,000 to $50,000, all right? Now, what is interesting, let's just keep this $100,000 RMD amount. What Holistiplan can tell you, whether you are eligible to use this explainer or not, is what are the savings versus taking a taxable distribution and then making an itemizable donation, right? So we're already saying this QCD is better than if you took a full $100,000 distribution and then did a $50,000 donation that would be itemizable on Schedule A. And the savings versus just taking the taxable distribution and not donating anything at all. Right. So I think there was one person who wrote in a question about, hey, can I show the difference between doing a QCD versus doing a donor advised fund? And the answer is, yeah, you can actually do it within the screen itself. But there's another way that you could do it too that we can show by just doing a comparison between the two scenarios. So Caroline, you asked this question. We get this all the time. Are you planning to make an adjustment to the software where the QCD amount will reduce the total taxable IRA amount, or are you planning to leave it as is? So right now we're going to leave it as is. We are talking behind the scenes about doing a revamp of this worksheet so that it might show like total distributions, taxable, and so on. Here's the challenge that we run into, because I realize that it seems on the surface that's an easy fix. we have to be cognizant of backwards compatibility, right? So if we make a change going forward, it's going to muck up everything that has already been entered into Holistiplan. And so we need to be aware of what that change is going to look like and how it might impact scenarios that are already built in. And we don't want to just do that willy-nilly and then have people wondering what's going on here with my scenario. So I totally get it. Like, I think we're actually in agreement on the Holistiplan side that we'd like to be able to show total tax-free, taxable, even potentially give the opportunity to show, what's the percentage that might be taxable if your IRA has basis in it, right? We're just not there yet. So yes, in an ideal world, we'd be able to make that switch tomorrow, but there are some of these second and third order things we need to be aware of if we make a change to it the way that we've already built it. So Caroline, I hope that answers your question. So Adam asked a question, can you briefly explain why the QCD is better than taking a taxable distribution and then donating? Sure. So I think actually one way of looking at that, Adam, would just be, let's run two side-by-side scenarios, right? So let's make this one our baseline. And we'll say we've got $100,000 IRA distribution in taxpayer one for our baseline scenario. I'm going to add a scenario. I'm going to copy from my baseline. And in fact, let me come down here and I just want to make sure that I deleted. Yeah, we don't have any charitable stuff going on down here. So we're taking the standard deduction. So here's my baseline. I'm going to call this one 2022 50K QCD. All right. So I'm going to come back to my IRA distributions worksheet. I'm going to scale down my taxable distributions and I'm going to up my $50,000 qualified charitable distribution. So what's happening here? One of the cool things with Holistiplan, with our new version of scenario analysis, if you hover in between two scenarios, you'll see this little triangle. That triangle, if you open it up, that's going to be the opportunity to show comparisons between the left and the right scenario, right? So the left, anything you see here that's in red means that the scenario on the right is lower than the scenario on the left. Anything that you see in green means the scenario on the right is higher than it is on the scenario on the left. So with this $50,000 QCD, right? So yes, so somebody's saying I need to do an apples to apples comparison. I need to do a cash deduction. So absolutely true. So let's go ahead to our charitable thing, do a $50,000, boom. So what's going on here? So right off the bat, income is $50,000 lower on my QCD side, right? Because I have $50,000 that isn't even showing up on my tax return at all, right? I've also got a higher deductible medical expense on my right-hand side. Why? Well, because my AGI is lower, right? So the threshold to get deductible medical expenses on this side, with this particular scenario, this $12,000 medical expenses is not even deductible with my baseline because my AGI is too high. But by bringing my AGI down, I actually now have some deductible medical expenses. Now, it's not going to matter all that much because I'm still not itemizing over here and I'm itemizing over here. But now when I come over here, taxable income, even with this big itemized deduction, is still lower on the right-hand side. And because I'm lower, I'm going to have a lower, I'm going to actually be in a lower marginal bracket. So my total tax is about $8,600 less than it is on my left-hand side, right? So AGI is lower, taxable income is lower. I've gotten into a lower tax bracket with my ordinary income. So that's where I'm going to get that the QCD is better, even if I'm itemizing. Right, even if I'm itemizing. Now, conceptually, why is that the case? So think about what's happening in my baseline scenario or my QCD scenario, right? I'm not itemizing, but I'm not terribly far. What's deductible here? I've got, call that $3,000 of deductible medical expenses and $6,000 of SALT taxes, so $9,000, right? Even over here on my baseline scenario, I actually only have $6,000 of itemizable deductions. What that means conceptually is that I still have between the $6,000 SALT tax and where my standard deduction is, the first $22,700 of my charitable gift mean nothing from a tax point of view, right? Because even if I didn't do anything, I'd still get a $28,700 standard deduction. It's only once I've gone over the standard deduction amount that the next dollar of that charitable gift is effectively deductible. So of this $50,000 charitable gift, how much of it is deductible? Well, really only $21,300 versus on this side, all $50,000 of my QCD is effectively done with pre-tax money, right? So that's why, at least in this case, the QCD is better than taking the taxable deduction, right? So how did I do the comparison between scenarios 2 and 3? If you hover in between any two scenarios, there's going to be this little triangle button. And when I hit that, it's going to expand out, and that's my comparison column, right? So Adam, hopefully that that answers your question. So there's a question that came in: is there anything built out specific to charitable remainder trusts? Yes and no. I mean, there's nothing that's going to be specific to charitable remainder trusts themselves, but will allow you to show what the charitable deduction would be for any gift that you do to a CRT. The challenge that we run into is that the calculation for what's deductible based on the gift itself has so many other variables that aren't going to be part of your tax return, right? So it's going to be based on life expectancy and the rate of return that you use and beneficiaries and things like that. So there are other calculators off campus from Holistiplan that will say, okay, if you do this and you have these variables, here's what your charitable contribution amount would be. And once you have that number, you can actually put it into somebody's Schedule A, but there's not going to be a workflow specific to CRTs within the Holistiplan scenario analysis. All right, so I said I'd go over the two explainers here. I'm going to start with the one explainer here for our qualified charitable distribution one. Now, so these explainers are available to people who are on the premium subscription. So that's anybody who's on the $9.99 plan and higher. Once you enter something in one of the QCD boxes, you can just click on this and it will bring up the explainer module. So the QCD explainer, in fact, all the explainers, the intent here is to help you explain these concepts where you don't have to come up with the same drawing over and over again, right? So, again, for folks who have seen a lot of these, I'm still a practicing advisor, been doing this for over 15 years. And the number of times I've had to draw what a donor advised fund is or how a QCD works is pretty high. So isn't it nicer to just be able to have I'm going to say a page, but this is intended to be an on-screen deliverable where you can walk through what is a QCD to somebody who's never done one before, right? Who's eligible? How does it work? Why might they be better than itemized charitable donations? So Adam, this kind of gets to what you were talking about right here. And then you can actually show on screen, here's the difference, right, between doing a taxable distribution and making the same charitable contribution versus a QCD, right? Now within here, there are a few other things that you can manipulate if you want to, right? So we can do, the control panel will tell you if you don't want to show any of these particular modules, that's fine. There's a little language in here about how, some advisors like to use dedicated checkbooks with their clients who have IRAs. So instead of making small dollar trades and then figuring out how to get money out of the IRA using a form, your clients could just write a check. Now, whether or not you want to do that, Holistiplan is agnostic as to whether or not that's a good idea, but some people wanted to have that as part of their QCD explainer. And then you have two different scenarios. You've got your savings versus taking the taxable IRA distribution and then doing an itemized charitable deduction, or just the savings versus taking the distribution and not donating anything to charity. So this is our, for the person who is asking about, they want to make gifts out of their donor advised fund instead of just doing a QCD. Here's your straight up look. Here's how much it's costing you on a tax basis for doing things the way that you're currently doing them, right? That's a pretty big deal, right? The other explainer that we've got is related. It's technically supposed to be for donor advised funds, but it can actually be used for more than just donor advised funds. So I'm going to come back down to Schedule A, if I can find it, and click on, it doesn't really matter the dollar amount here, right? Because you can do a $50,000 donation of cash to a donor advised fund, doesn't really matter. And open up the DAF explainer. So again, conceptually, we're looking at what is a donor advised fund? How does it work, right? So you give money to a donor advised fund or securities. That's technically your charitable gift right there, because the donor advised fund itself is a 501c3 nonprofit. You as the donor can then recommend grants from the donor advised funds to charitable institutions. Technically, the DAF doesn't have to honor your grant request, but it's pretty unlikely that they'll not do that. And then you only report your gift to the donor advised fund. You don't report any of these other gifts, these other grants. These aren't additional charitable deductions that you get to take. You just take the one that goes to the donor advised fund, right? And then you get that tax deduction. Why are they helpful? You know, a couple of different reasons. Again, some of these are going to resonate more with other people, but you know, the ease of doing just one donation as opposed to multiple donations, the ability sometimes to make gifts anonymously, the ability to make smaller dollar gifts to certain nonprofits where you wouldn't gift, you know, $500 of appreciated stock, right? That's not worth the trouble that it costs you, the advisor. But if you gift a larger amount of appreciated stock to your donor advised fund and then have your clients do a $500 gift out of there, that's a nice way of dealing with appreciated securities in a more tax efficient way. Now, again, you don't have to keep any of these if you don't want them. So the control panel allows you to hide or show how does it work or any of these infographics. That's totally up to you. But then down at the bottom, we'll have the 3 different possible scenarios or situations you could show somebody based on your choices down here. The first one that many folks choose, not everybody, but many folks choose, is you're having a high income year. So maybe this year is the one where it makes the most sense to do a contribution to a donor advised fund. And we might say, you know, sale of your business. Notice that as I'm typing the name of the event, that's going to plug itself right back in to the one-off income event scenario that we chose. Here's the tax estimate without the donor advised fund. Here it is with the donor advised fund. So like doing this $60,000 or $50,000 charitable gift helps reduce taxes by, you know, about $6,000. Now, I said how you could use this. It doesn't have to be a donor advised fund, right? So you don't really need all this other stuff for this. You could also do this as I just want you to bunch your charitable donations into a single year. The donor advised fund is just a way of doing that. And the rest of this is meant to help explain that donor advised fund concept to people. But if you don't want your clients to do a donor advised fund, you can still use this in that same way of, I just want you to bunch your gifts into a single year. Now you can do this with a couple of other possible scenarios inside of the control panel. So the first would be, you're regularly giving charitable gifts and you're lower than the standard deduction. So let's say that, you know, somebody has, I don't know, no other itemized deductions, but they're typically gifting $10,000 per year. Well, you could show this idea, and this is what I was just talking about. Here's their standard deduction. Let's say we wanted to bunch 4 years worth of gifts into a single year. So here's we're just taking the standard deduction and making that $10,000 gift. So all we're doing is taking the standard over these 4 years. No, and we say this down here, we're not adjusting the future deduction years for inflation. So this is just the current dollar amount of the standard deduction. And here's what it looks like if you bunched everything into year 1 and then just took the standard deduction for years 2, 3, and 4. We see that in total, the total deduction amount is higher by doing the DAF. It's not your taxes are different by $14,000. It's a $14,000 difference in your total deductions over 4 years, right? The other scenario that we see folks sometimes do is in those situations where you're never using the standard deduction. So maybe in this case, your other itemized deductions were $20,000, right? So we do a $20,000 other itemized deduction. You're typically giving $10,000. We'll still use this 4-year time frame. Standard deduction still $25,900. We can see, okay, yes, you're itemizing in all of these years, but if you bunched everything into a single year, your total deduction amount is still higher by pulling all of this into year 1, right? Now, again, you can use this but without even using the donor advised fund piece, although it says donor advised fund all over it, but conceptually it's going to be the same thing, right? We're just pulling all of the deductions into a single year to get a higher total deduction over a multi-year period. The donor advised fund is just one way of doing that, right? So Emily and Madeline, I know that you guys were answering some questions as they came in. Was there anything that you felt we needed to talk about before we wrap things up for our one-off gift of giving, how to model charitable contributions inside of Holistiplan?
I didn't see any.
Okay. Well, thank you very much. Thank you very much. Thank you very much, everybody. We will get this recording out to people again. If it's not today, then it'll be early tomorrow. It just needs to go through the recording and rendering process. But please feel free if you have additional questions about anything that you see in Holistiplan, be it charitable giving or not, please use the contact support links that are at the top of every page. We always encourage you, particularly if you're doing stuff out of scenario analysis, use the contact support page when you are on scenario analysis itself, because when you do that, we will get a link directly to the screen where you were when you hit the contact support key, right? So we'll see that, we'll be able to jump right to it. We are here to help. We want you to be tax planning superstars, so you look great in the eyes of your clients. So don't be afraid to give us a holler. But absent that, have a wonderful rest of your day, and we will talk to everybody soon.